Practical accounting. Number 6. The business cycle. Remember in lesson number 3, I mentioned the 3 essential elements of business: customer, product and cash. Now it may sound simple, that's because it really is. Business is just the movement of 2 of these 3 elements: product and cash. The product moves in one direction, from the business person to the customer. The cash moves in the opposite direction, from the customer to the business person. This is called the business cycle. The speed and frequency of the movements generates the volume of business. Business is good when both speed and frequency are high. Business is bad when both speed and frequency are low. The business person and the customer do not move. The product and cash move back and forth in opposite directions between them. The movement of product and cash between the business person and the customer is called the buying and selling. When you buy, you are the customer. The seller is the supplier. When you sell, you are the supplier. The buyer is the customer. Buying and selling are the 2 main activities in business that generate income and expenses. Number 1. Selling generates income. Number 2. Buying generates expenses. When you buy a product for reselling, this is an expense, called cost of goods. When you buy a product or service to run the business, this is called cost of operation. The accountant presents selling and buying in terms of income and expenses. It is represented in a profit and loss account as selling. Sales are shown as income. Buying is the purchase of products for reselling, shown as expense. Cost of goods. Income less cost of goods is shown as gross profit. Purchase of product or service to run the business is shown as an expense. The cost of operation. Business is essentially buying and selling, made up of 2 cycles: the buying cycle and the selling cycle. Another business tip from learnaccountingfast.com. Next, the buying cycle and the selling cycle.